traditional 15-day Chinese New Year holiday starts on Sunday, the 22nd of January, to welcome the Year of the Rabbit, and that may well be the major macroeconomic development of the coming week. However, do keep an eye on the latest policy statement from the Bank of Canada on Wednesday, the 25th, to see if it offers any clues as to what the US Federal Reserve and the Bank of England may do on the 1st and 2nd of February, respectively. After no less than 365 separate interest rate increases from central banks in 2022, we've had 5 already in 2023, according to the website cbrates.com. Israel, Romania, Serbia, Peru, and South Korea, if you must know. What's interesting is that 4 of those hikes were just 1 quarter point ones. Israel went for a half percentage point increment. This is a lesser rate than many of the increases seen in 2022, when the Fed rammed through 4 3/4 point increases as it took the Fed's funds rate to 4.5% from 0.25 in the fastest cycle of increases ever. The Bank of England did get on the act to some degree as it took the base rate to 3.5% from 0.25%, helped by 1 3/4 point increase and a couple of half-point ones. The narrative may now be changing again. Stock and fixed income markets are pricing in a peak in global interest rates in the first half of this year, followed by a pause and then a pivot to rate cuts, a prospect which is currently supporting bond and share prices alike. And the first step to the peak and pause is a slowdown in the rate of increases, and this is why the Bank of Canada statement may be important. It's expected to raise rates by just 0.25% at this meeting to 4.5%, and coming after similar moves from Korea and others, markets may start to speculate that the Fed and the Bank of England will also start to move more slowly. Back on the company front, year-end trading updates will continue to come thick and fast, accompanied by a smattering of first half and full year results releases along the way. Companies which may be worthy of further note include the following, although some of these dates could still be subject to change. South 32 on Monday the 23rd of January, Associated British Foods and Saga on the 24th, Fresnillo, EasyJet, Tullow Oil and Watkins Jones on the 25th, 3i, Wizz Air, Dr. Martens, Britvic, Rank, Foxtons and CVS Group on the 26th, and Paragon Banking and Accrol on Friday the 27th of January. But the company which could just cause the biggest fuss in the week ahead is FTSE 100 firm Diageo, the global drinks giant, best known perhaps for its Johnnie Walker and Talisker Scotch whiskies, Captain Morgan rum and Smirnoff vodka, as well as Guinness. Well, it's due to report its first half results to the end of December on Thursday the 26th. The shares are almost unchanged over the past year, and this may be partly down to the stock market rotation away from quality compounders towards value, more cyclical players, concerns over demand in China, a key market thanks to lockdowns and COVID, a weaker dollar, and also the cautious outlook statement from the company itself alongside the full year results in July, when they warned of input cost inflation, geopolitical uncertainty, and a potential weakening of consumer spending power thanks to increases in the cost of living. Diageo's brands may offer it some protection against input cost inflation thanks to the pricing power they bring, although the premiumization strategy and focus on so-called super premium plus brands may now face a test if the economy dips and the squeeze on consumers' ability and willingness to spend proves persistent. Analysts will look for comments on cost inflation and how price increases and cost efficiencies can offset it. They'll also view this first half set of results relative to the company's medium-term goals out to 2025, reiterated by Chief Executive Ivan Menezes alongside those summer full-year figures. And those targets are organic sales growth in the range of 5 to 7% a year, on organic operating profit growth in the range of 6 to 9% a year. On organic means excluding acquisitions and excluding currency movements. When it comes to this update, analysts and investors will look for 3 near-term indicators from these first half results. The first is organic growth, so they can check out underlying sales increases, excluding currency movements, acquisitions and disposals. In the fiscal year that ended in June 2022, total sales were up 21% and organic sales were up 21% as demand recovered from 20 and 2021's lockdowns. Volumes are up 10% and price and mix added 11 percentage points to sales. Analysts will look for details on volume and price this time around too, as well as on how premium price brands in particular are faring. Any comment on sales trends in the home or off-trade and out-of-home or on-trade markets will also be welcome. As a benchmark, analysts are looking for full year sales growth on a stated basis of 11% to £17.1 billion, while first half sales a year ago were £8 billion, when consensus is looking for a 7.9% increase in organic sales for the first 6 months of the year. The second key number is profit. For the full year, analysts are expecting a 20% increase in stated pre-tax income to £5.3 billion, helped by the absence of some one-offs last year. For the first half, consensus is actually looking for a tiny dip in the operating margin and a 7.6% increase in organic operating profit, and that translates into earnings per share on a consensus basis of just over 100p compared to 85.6p in the first half last year, again helped by the absence of some of those one-offs. And finally, attention will switch to cash returns to shareholders. Diageo raised its dividend by 4% in the year to June 2022 to extend an annual growth streak that dates back to 1999. And analysts are expecting a 10% increase for the whole of this financial year that ends in June 2023. That growth rate provides a benchmark for the first half. And remember that Diageo paid a 29.36 pence a share interim a year ago. Diageo is also running a share buyback programme. In 2019, it announced it would return £4.5 billion to shareholders via this mechanism, and after a postponement because of COVID, it's still running that through to 2024. Now, it had reached £3.6 billion in 3 tranches by June 2022 and launched the fourth and final phase in November, with a goal of perhaps getting to that £4.5 billion figure by the end of this financial year, in fact, in June. I hope that you and your families are all in good spirits and keeping well. Thank you for watching, and I look forward to seeing you again next week.